Hello all, welcome to yet another episode of Mallu.ca, and today it's going to be an interview with an established mortgage broker in London, Mr. Chirag Dave. So he'll be answering most of your questions about buying your first ever home in London or Ontario. Okay, so now let's go to the video. Hi Chirag, welcome to another episode of Mallu.ca, and we have some questions regarding first-time home buyers in Ontario, Canada.
Thank you so much for having me here, Tanya.
Okay, so shall we go ahead?
Sure.
Okay, so my first question would be people would like to know, what does a mortgage broker do, or how he or she is different from a real estate agent?
All right, so in a real estate market, there are two main pillars, I would say. One is the mortgage or the mortgage brokers, and another one is real estate agents or the brokers. So real estate agents, basically, they just interview the client. They know what is the client requirements, and based on their requirements, they just look for a house in the area that the client is willing for. At the same way, mortgage broker or the mortgage agent, what do is they first evaluate the client. They just know that, okay, when did they came to Canada, what is their income, what is the status, how much do they make, what amount of mortgage are they qualifying, what are they willing to buy, how much savings do they have, what kind of down payments are they willing to put. So first they just evaluate the whole client's financial situation, and based on that they just approve the client with whatever the amount they qualify for.
Okay, so it's basically the funding. They look after whether you'll get a loan in order so that you could buy your dream home,
that's
right?
Yeah. So basically they take care of all the funding part.
Of all the fund. Okay. And how is the London real estate market at this time? From a mortgage broker point of view?
Yeah, I would say I have been dealing in mortgages, and especially the London market since 2000, I would say 2015-16, and I have seen lots of ups and downs, and right now the market is just, it's like going up to the skyscraper. The prices, you might know, the prices have been increasing day after day, year after year. It's not stopping anywhere. Even the builders nowadays have the new pre-construction projects that they are opening. You might have noticed that the prices are more than or close to what the resale value is. So builders are also booming up the prices, and the market is going way too good. It's going up and up day after day.
Okay, so if we'll come to the main thing, that is what would be the existing programs, plans or incentives that is there for a first time home buyer in Canada?
So
precisely in Ontario.
Yeah. So basically, for the first time home buyers, the new immigrants who come to Canada, there are lots of new programs, incentives, as well as cashback offers that few few banks, financial institutions are giving. So new to Canada program is something where you are in Canada within 2 years, then you qualify for a mortgage in new to Canada program. There are two criteria. If you put more than 35% down, then you don't need any income requirements. You just have to have the 35% down payment, and you should have the 1 year principal and interest amount savings in your account, and you qualify for a mortgage. There is also new programs with first time home buyers that the government has introduced, especially the CMSC, where you put the 5% down, the CMSC will chip in another 5% and will get you the mortgage with 10% down. So that helps the client to qualify for mortgage in terms if the income is low. Yeah, and also the drawback on that program would be like, when you sell the house, whatever the market value is, you need to pay 5% based on that market value to the government, CMSC,
to the government. And also but we have to pay back that amount as
That's
well,
true.
right? Like at the
That's true, you need to pay back. There is no interest or anything charged, but indirectly
but at least
the value when, see, for example, if you're buying a house for 500,000 and you're chipping in 5% as well as government, CMSC is chipping in another 5% down, so total 10%. Down the road, after 10 years, 15 years, if you want to sell the house and the value of the house is say 800,000, so the government will not charge 25,000 as the money back. They will charge 40,000, which is 5% of 800,000. So that's how they make the money. Yeah, they don't charge the interest. Yeah, but they make the money that way.
But they know, even like I think most of the first time home buyers are now buying a second home or a third home. So like they'll get their money.
That's true.
Okay, and so now I know that like we have done the mortgage with you, so we know it's kind of like a time consuming process. So could you brief about the mortgage and the purchase process, like the pre-approval and the mortgage approval,
Okay, so very first, when we just, if I'm getting a call from a client or if there's a referral or the realtor giving a reference, I should first go through the client's whole scenario and I just explain them what are they willing. Are they willing to get a pre-approval or they are willing to get a firm approval? So what I do is like basically I evaluate themselves. I get all the documents, get the Equifax report, see what the liabilities, what are the income, how much they qualify. There is, online also nowadays you will see lots of my clients, they go online and they find the mortgage payment calculator and stuff. And they just calculate themselves and they come to us and say, oh, I have used this tool.
I know, we also have done this because before consulting a real person, we always think we could do our own kind of Google.
Definitely, now everything is there in Google, right? There is you can find each and every stuff out there. So pre-approval is also one of the thing which was crucial back, I would say, in the days, because nowadays pre-approval is like, because of inconsistency of the market, we don't know what would be the value that client is willing to buy and what will he end up buying. You know what I mean? Because see, if they go for 500,000 house and because of multiple offers and bidding wars and stuff, they end up buying 600,000, 550. So we don't prefer giving pre-approval. We would give them the number that you would qualify between so and so range, but we go for a firm approval when they have the 5 days finance condition, or even in case if they have to put a firm deal, we go from there.
And then so the mortgage approval would be based on their liabilities and so could you explain a bit about that?
So for mortgage approval, there are 2-3 things very important. Very first is the credit. So when we pull the credit report, either financial institution uses Equifax or TransUnion. These are the two main main body of credit reports. We see what are the liabilities, what is the credit score. The minimum requirement of credit score is 680 plus. Even if it's 660, it's okay. But anything above that would be considered in good and very good, excellent credit scores. That really helps us to make the decision. We know that client can manage their finances properly. So one is that. Second thing is the income. We need to know that client has a strong income, and reason why the government has started a new program around 5-7 years ago, which is called the qualifying interest rate program, where you will get an interest rate for a mortgage, say 2%, but you need to qualify for around 5%, 5.25% interest rate, because just in case if the interest rate
if the interest
rises, you are able to pay the mortgage and you don't default. That's the reason government has started this program. And so income is also one of the main pillar in approving the mortgage and qualifying for a mortgage. The third thing would be the property that you're buying, the property tax, the area that you're buying, the price that you're buying, how much down payment are you willing to put. So you should have enough savings to put down payment. So there are different criterias and different slabs where government has is charging. Like for example, if you put less than 20%, there is a CMSC fees, which is called an insurer fees as well. So if you put more than 20%, there is no fees that you need to pay. But if you put like for 5% down, the government will charge 4.1% of the mortgage amounts.
Of the mortgage amount.
So if the house value you are purchasing is 500,000 and you are putting 5% down, which is 25,000. So the remaining 475,000, the government will charge 4.1% as a CMSC fees. The same thing will change when you put 10% down. It drops down to 3.1% of the CMSC fees, and when you put like 15% down, it's 2.8%. So
the more you put, the
lower the fees are, CMSC fees. And reason why when you put 20%, you don't have to pay any CMSC fees. It's called conventional mortgage, and you qualify. Without
like I often hear people saying something called like a gift money. You could get it from your parents, and like, is it legal? Is it okay?
Yes, definitely. In all the banks' policies, gift amount or gift letter, which is properly needs to be signed, dated, has the proper address and the stamp of the financial institution. All the banks, they have the gift letter, because many of the times there are new immigrants who have savings in back home, and they want to get it here, or the parents want to give something to their kids, for buying the first home in Canada. So gift is totally okay. The only criteria for gift is it needs to be with your parents or grandparents or siblings. It cannot be with cousins or friends. Has to be with brothers, sisters, blood relation, and parents or grandparents.
And how much money? Like, is there a limitation?
Yes. When it comes to less than 20% down, which is a CMSC insurer, and you are putting, say, for example, 10% down, then they want at least 5% to be from your own savings, and the rest 5% could be the gift.
Okay. So that's a real advantage.
Yes, that's very good advantage.
If you don't have, if you
don't have so much savings, and if you want to buy a house, that's a good thing, I would say. When you put 20% down, there is no any such criteria. But people try to put 10 to 15%. 10 to 15% you can get it from a gift. The rest 5 to 10% you can have it from your own savings.
You could. Yes. And also about the income that you mentioned, is it mandatory that like both the husband and wife should be having a full-time job in order to qualify?
No. For income income criteria, it could be either husband or it could be either wife, or they both can have a part-time job. They can both have a full-time job. Based on the purchase value and requirement, they can qualify. There is no any policies that says that both of them it should be a full-time job, or both has to be employed. There is one person can be employed, and if he qualifies, he can get a mortgage.
Another thing I wanted to ask was about the credit check you mentioned. So if you have a good credit score, so so we'll be, maybe when you plan to buy a home, you'll be going around and talking to different institutions, different mortgage brokers. So like these many different credit checkings, will that affect our score, or is it like, is there a safe way to do it?
No, it's like, when you go to buy a car, and when you go to different dealerships, every dealer, they ask for a driver's license, they do a soft check, and they do check. Even when you go to apply for a financing or lease, for instance, then if you go to, say, Honda Finance, sometimes they send the deal to CIBC, TD, Scotia Dealer Advantage, different dealerships, and every dealer, they have their own program or own software where they pull your credit and check the score. So it does affect. Same way with mortgages. When you go, say for example, you go to TD and you get the mortgage, you get the things done, but the rates are not that competitive, and you see CIBC or HSBC is giving good interest rate, then you ask them to pull your credit and do the application. That way it hits the score. Definitely it's around 3 to 4 points for each credit check.
Oh, okay. So that is 3 to 4 points for each credit checks. It will be going down. Yeah. Okay. So it's better to plan in advance, ask your friends or things, and then decide on a
whoever is giving good competitive. There are many banks who would get an exception for you, or who would beat the rate. Like for example, if CIBC is giving 2.28, then you come to TD and say that, oh, I'm getting 2.28 from CIBC. Then TD can get an exception from the management and provide you that rate.
Okay. And so what is this like? Is there a prime rate and?
Yeah, sure. So prime rate is like standard rate, or you would say the benchmark rate that the government of Canada has approved or has used. So right now the prime rate is 2.45. Before that the prime went up to say 3.25, and it dropped down by 20 bips, 15 bips.
At the time when we were buying, it was just going going higher and higher. And
at that time the prime rate was pretty high. Now it dropped down. It's 2.45 right now. So
it does affect the mortgage rate in the sense that the prime rate is the deciding factor for other banks to set a value.
Definitely. So based on the prime rate, all the financial institutions, they give discount, or they add the rate about that, and they give the rates. So for variable interest rate right now, it's around prime minus say 1%, 1.2%. Same way. Different financial institutions have different rates. It all depends on the prime rates. Even sometimes the prime rate for mortgage is different for each institution. Like CIBC, RBC, they have a prime rate of 2.45%, which is the government of Canada has approved for mortgages. Whereas in TD, the TD mortgage prime rate is 2.60. They have 15 bits more than what they have approved. But at the same time, they give the more discounts towards the interest rate, they get the good interest rate.
And so when you mentioned about fixed and variable and all. So how to decide on choosing a mortgage rate? Like should it be variable? Should it be fixed?
I prefer variable interest rate, and that's what I give to my clients, and all my clients also like variable. I have spoken with many clients, many of the mortgage agents, as well as clients who are in real estate for more than a couple of decades, 2-3 decades. They all prefer variable interest rate, and they say at the end of the term you save more on interest
than the fixed. Even we took variable with you.
Variable is always preferable, and it's always better. Personally, for my house, my mortgage as well, I am using variable interest rate. When people say when there is no much difference between variable and fixed, then you go for fixed and lock it, right? But still, you don't know, when you lock it for 5 years term, if you want to refinance, want to sell your property, buy a bigger property, or if you want to do something, you get to pay a big amount of penalty, right, that they charge when you break the term or the agreement. Whereas in variable, it's just 3 months interest, and you can always switch from variable to fixed, but from fixed you cannot change to variable. So
and it depends on the financial institution which gave you the loan, right? The refinancing year, or is there a fixed year for everyone, year of refinancing?
So basically, whichever institution you have got the mortgage, it's like term, right? 4 years, 5 years term.
5 years term.
Sometimes you can refinance or renewal at the end of the term. Sometimes if you call and if you say that, oh, I want to do some renovation, or I want to upgrade to a bigger property, there is an option of porting the mortgage for the same term and the same amount. You can add more amount if you qualify for income for a higher house, and you can port the mortgage.
Okay. Like that is that the one that we call equity, getting equity?
Yeah, that is different. Home equity is like when you have the equity. Say for example, you bought the house 5 years ago for 500,000. Right now the value is 750,000, and you want to pull out the equity just for the investment for your kids to studies, or for renovation, which is called home equity line of credit. Whether you want to get it out, you can all do a port mortgage refinance. You can just keep the term portion which you have as is, and add a home equity segment to it. That way you can get another 100,000, 150,000, whatever you qualify and how much you have an equity on it. So for example, if the value of the house is say 800,000, all the banks, mostly their policies gives you 80% of loan to value. So 80% of 800,000 would max, they would give a home equity line. So 640,000. And say for example, current you have lowered down your mortgage to say 400,000. So you have that $240,000 that you can, if you qualify with your income, you can get it as a home equity line. Yes. And you can use it anytime.
And then we mentioned about different institutions that are providing loans, and then I've heard about what is the difference between an A lender and a B lender, and what are the pros and cons associated with both?
Yes, so basically A lenders are all the top 5 institutions, the RBC, CIBC, TD, BMO, Scotia, Bank of Nova Scotia. Plus there are also different A lenders like National Bank, HSBC, Street Capitals, which falls on A and B, both the sides. So all the top banks as well as few financial institutions are on A lending or A lenders. The B lenders on the other side are little small institutions, and they are basically for the clients who do not qualify with A lenders, either through the credit, through the income, and stuff like that. So they qualify with the B lenders, and the interest rate is little high. They are smaller lenders, so they are very possessive on
whether
interest rates.
The client will pay or not.
The reason why they charge more interest rate, they also charge lending fees, 1% of lending fees for each mortgage, to just cover up the cost for borrowing. And that way we have different lenders. There are also private lenders. Sometimes the deal doesn't go through till the end, and people have to go for a private mortgage. So there are private lenders who would give the money. There are big private lenders as well as small private lenders. So they do
it is
up to
illegal.
85%
Is it
loan to value.
so they are private lenders, they are institutions, or are they persons lending, rich people?
There are big companies also in private lenders, institution lenders, who are lots of big people who have lots of savings. They come together and create one institution, and then they lend the money.
Lend money and get
Yes, there are lots of different lenders, institutions who provide good rates with the private lending, which is close to B lenders, 3, 4, 5% interest rate. Right.
So what would be the cons on this B lenders or getting from the private lenders?
So with B lenders, as I mentioned, they charge 1% lending fee.
Yes, you said.
As well as the interest rate a little higher. Right, as well as in private lenders, their lending fees are more than 1%. The interest rates are more higher than B lenders.
And when buying a second home, will that affect in any way? From if you got the mortgage from a B lender?
No, it doesn't matter if your first mortgage is with B lender. Many people, they use B lenders, for investment purposes. they don't want to use the top 5 banks or A
Okay.
lenders in terms of, so it's all based on personal requirements. There is no like bank doesn't see that, oh, why they have the first mortgage with
B
B
lenders, there's
lenders, why
nothing
not
like
A
that.
lenders? So there is nothing
Okay.
as such. It's all personal choices. As far as you qualify, you have a good credit score, you can go with any institution.
Okay. And so, when would be the best time to change the lender, or what should make not just the end of term, but before end of term, if we decide, okay, no, I should change the lender.
Basically, before the end of term, if you want to change the lender, if it's variable interest rate, you get 3 months penalty. All the lenders,
3
they
months,
charge
okay.
penalty.
Okay.
Yes, so with variable interest rate, you get 3 months of penalty of interest payments, whereas in fixed, they do the interest rate differentials, which is called IRD. It's a term that is left plus what the interest rate you have received and what's the current interest rate. So it blends everything and it gives you one penalty amount, which is a little higher. So I wouldn't recommend for fixed mortgage terms to break the mortgage before the renewal, because unnecessary paying high interest rate wouldn't make sense, unless if it's a too much variance of interest rate and they are saving the money at the end of the day.
And so, what would be the most important things that you believe that a first-time home buyer should know, before approaching someone to get mortgage?
I would say many of time people they come to Canada, they buy different credit cards, or they get a credit card and then they forget about making payments, or they miss some payments and stuff. So very first I would say credit. Pulling your own credit before looking for or even thinking for buying a house it's a must. And every year if you pull once if you pull your credit, it's good. You know what is what's going on. If there is no any other hidden lender or hidden institution that is checking your credit, and you might have online sometimes accidentally you might have given an access or given an authority for them to access your credit,
that
right?
Happens.
Yeah, so it's always we come with when we come across with the clients and we ask to pull a credit, or when we pull a credit, we come with surprises sometimes. And even if it's like after 10 years they come or 5 years they come to buy a house, and then they think that, oh, this was, I closed it, I paid it, I don't know why my credit is brutal or my score is not good, right? So surprises do happen.
So keep a check on how your credit is going before you decide to buy something.
I always recommend all the clients to pull the credit report once, which is good. It's a healthy thing to know about your credit, because that's what it is in this country, right? It's all about credit in finances. Even if you want to buy a house, if you want to buy a car or anything related to finance, so credit is important. Second, savings is important. You make sure you have good savings and stuff, and a strong income, and with a strong job tenure. That is also important. If you have a longer tenure of job, that helps to make a decision for approval of mortgage.
So
these are the criteria.
And so then no one knows, I think, unless they get into buying a house, that what would be the additional charges that comes with it. Normally we just go with such and such amount in our bank accounts, thinking that is there for the down payment and some amount for the CMNC fees, and that's it, and there's nothing. And then all of a sudden when it nears to closing is then we think like, what are those additional costs that come in at the end?
It's a very good question, I would say, because lots of times, when you buy a house, you just think that, down payment,
that's it.
And that's it. We are good. I have that much money, I can go buy a house. But there are lots of charges, like, as CMSC is one of them, which is added to the mortgage. But based on the policies of banks, when we do the mortgage, we are taught that you calculate 1.5% of the purchase price as a closing cost.
Okay.
So for example, if the house is 500,000, right, you add another 1.5%, which is another $7,500.
Okay. I remember you mentioning that to us, like, you should have that extra something because there's going to be more fees coming up, like the lawyer
Yes,
fees.
because what happens, lawyer's fees, there is a title insurance, there is lawyer's title insurance, there is lien on the house, so lawyer puts a lien title, they check, make sure the title insurance code. There's land transfer tax.
That's another one.
Right? Because the land that you are buying with the property, there is a tax associated to that. So for the first time home buyer, they get a rebate, $2,000 each per person, whoever is in the title of the property. But usually bank's policy says 1.5%. It's less than that, but to be on a safer side, they also to have more, and they ask us to, if you're putting 10% down payment, to add another 1.5% as a closing cost. That helps for the client for a smooth closing, and they don't come with surprises at the end when the lawyer asks for a draft at the day of closing.
And also one thing is there any formula to calculate the maximum mortgage amount one could get based on their annual income?
See, there are tools, mortgage affordability tool. If you go online and just Google search it as a mortgage affordability tool, it will let you know that lots of questions are asked, like what are your expenses, current property tax, mortgage statement, your income, any other personal loans or any other auto loans that you have. So it will ask you your regular home expenses, like groceries, any insurance if you have, any child RESPs or RSPs you're contributing, or any insurance amount that you are paying every month. So it will calculate all the expenses, ask you lots of questions. It will give you a number. I would say it fluctuates because every other day you see there is a difference in the qualifying interest rate for mortgage. There is difference in the interest rate what is getting in the bank.
But at least you get just a figure of
you get a rough figure where when you go on Google and just do a mortgage affordability calculator.
And
it's a very good tool.
And now that was all about for the first time home buyer. So now what would be the criteria for a second time home buyer, like in order to get mortgage approval? Is the all the process will be the same, but is there anything else?
No, it's almost the same process as you buy for a first time home mortgage. The same, all the documents, all the requirements are there. Because it's a second home, it would be either an investment, or you might be selling your primary and buying another bigger primary house. So if it's an investment, you needs to be 20% minimum down. Based on the policies, you cannot put 5% or 10% down. 20% should be your savings. It could be from your gift as well. That's okay. With the investment property, you might rent it, so you can, while doing an application for mortgage, you can ask for a market rent, and we can, while doing an appraisal, we can put that please, the appraisal, please look for a market rent. What is it, 2,500, 2,300 per month, and we can use 50% of that amount towards the income. So that adds up your income, and it's easy for you to qualify.
And then there is and then you don't get any rebates, right? Like a first time home buyer.
No, for the investment property you don't get, because you're making money out of it.
You're not
so
getting
government
anything.
do not want to give any rebate.
Now my final question would be how is TD? Of course, you're working for TD, and how is TD helping Canadians to find their dream home?
It's a very good question. TD, Canada Trust Bank. It's a very old and very big institution. It is all over the world. There are lots of branches, even in India back home. There is in States, you see lots of branches are there. The maximum amount of branches with the longer hours is just TD
Okay.
Bank. So TD is very has a good funds, good savings with them for mortgages as well as to lend the money. The policies are pretty good. They have good cashback offers for the mortgage. When you buy a house, and if you open an account or if you have a TD account, you use that account for mortgage payments, you get cashback.
Okay.
So there are four tiers of cashback: 500, 950, 1500, and 2500.
Okay.
So based on the mortgage amounts, so between 1 to 300,000 you get 500,000, 3 to 500,000 you get 950, and then 500 to 750 you get $1,500, and above 750 mortgage you get $2,500 as a cashback.
Okay.
So there are different tiers breakdown, and TD is good with multiple properties, investment properties. If you have with first time home buyers, new to Canada, new immigrant, non-resident program, non-permanent resident program, there are lots of different programs. Flex line product. Flex line is kind of home equity line. They have different name. It's called flex line product, where you can have a term portion as well as revolving portion, which is home equity line. All the banks charges more interest rate on home equity line segment when they give it. It's usually prime plus 0.50 or 0.10. TD also have seen giving prime plus 0.20, which is a good interest rate. So prime is 2.45, it will give you minimum 2.65 interest rate. So, and it's kind of a line of credit. So whenever you use, you pay interest. If you don't use, you don't pay. So that's a good program for client who can manage the finances and who are good in utilizing the credit.
And that's great to know. Who is going to take a new bank account with TD? Is there any existing offers or anything at this time?
Yes, at this time, if you just open a new account, if you are not buying a mortgage or any other product, you get $300 cashback.
Okay.
Yes, you just have to have 2 pre-authorized payment and one, the payment should be coming into the account.
Okay. Now at the end, what do you have? You have something to say to our viewers.
Yes, I would like to say, for mortgages, if you have any questions, any concerns, I will send my details to Dania. She's doing a very good job. Thank you so much for inviting me.
No, thanks a lot.
It was nice talking with you, and after a long time we connected. I remember doing the mortgage and stuff. It's just busy going on day by day, every month, every year. In this industry, it adds up more clients, and you get more busier and busier. So
personally, we had a great experience, having dealt the mortgage with you. And thanks a lot for, spending your time and participating in this interview. Thank you.
It was my pleasure.
You have a great day.
You as well. Thank you so much.
Take care.
Bye everyone.
That's it for today, and I hope you liked our video. And if you did like our video, please subscribe, and if you didn't like, hit the dislike button. And if you have any comments and suggestions, please write it in the comment box, and please share if you really enjoyed watching this video. And until we meet again, bye bye.